Hello, and welcome back to Boni's Life, the channel where we navigate the electrifying and sometimes terrifying world of cryptocurrency with our brains fully switched on. If you're watching this, you've probably noticed the crypto market has been less to the moon and more stuck in traffic on a Monday morning. The charts are red, the headlines are screaming about a crypto winter, and the fear and greed index is basically telling us everyone is hiding under their beds. As of today, November 26, 2025, the global crypto market cap is hovering around $3 trillion, which sounds massive, but it represents a significant dip, with about $1.2 trillion vanishing from the market in just the last 6 weeks. It's enough to make even the most seasoned investor a little nervous. But what if I told you that this bearish climate, this sea of red, is not a crypto apocalypse? What if it's actually an ocean of opportunity? It's true. While many are panic selling, the smart money is quietly making moves, positioning for the next wave. This isn't the time to run. It's the time to learn, to build, and to strategize. And that's exactly what we're going to do today. We're going to dissect the best investment strategies for this exact moment in the market cycle. We'll explore how to generate returns even when prices are flat, and we'll break down the specific actions you should take, whether you're an active hands-on trader or a passive long-term investor. So grab a coffee, silence your notifications, and let's figure out how to make this bear market work for you. Trust me, by the end of this episode, you'll be looking at these red charts not with fear, but with a sense of intellectual excitement. Let's get into it. Before we dive into the nitty-gritty of trading strategies, let's take a moment to really understand the battlefield. A bear market in traditional finance is typically defined as a period when prices fall 20% or more from their recent highs. In crypto, however, it feels more like a Game of Thrones winter, long, harsh, and you're never quite sure when it's going to end. We've seen the total crypto market cap shrink from its all-time highs, and the fear and greed index is currently at 14, which is officially in the extreme fear territory. This level of fear is palpable. It's the digital equivalent of a stampede, where everyone is rushing for the exits at once. But here's a little secret the veterans know. Extreme fear is often a contrarian indicator. When everyone else is terrified, it can be the best time to be greedy, or at least strategically opportunistic. So, what's causing this bearish sentiment? It's a cocktail of factors. We have persistent macroeconomic headwinds, with central banks around the world still grappling with inflation. Regulatory uncertainty continues to cast a long shadow, with governments still figuring out how to handle this new asset class. And let's not forget the natural cycles of the crypto market itself. After a massive bull run, a correction is not just likely, it's healthy. It's the market's way of shaking out the speculators, the get-rich-quick schemers, and the projects with no real substance. What's left is a stronger foundation for the next phase of growth. The data from CoinGlass shows us that while trading volume is down and liquidations have cooled off, the open interest in options is actually growing. This suggests that sophisticated investors are not abandoning the market. They are simply changing their strategies, using more complex instruments to hedge their bets and position for the future. This is not an exit, it's a recalibration. And for those of us who are willing to look past the fear, it's a classroom, a workshop, and a launchpad, all rolled into one. Now let's get to our first strategy, and it's a classic for a reason: range trading. Imagine a tennis match where the ball is just going back and forth over the net, never really breaking out to one side or the other. That's a range-bound market. Prices are bouncing between a predictable high, the resistance, and a predictable low, the support. In a roaring bull market, this is boring, but in a bear market, this is your playground. Range trading is the art of buying at the support level and selling at the resistance level. It's a strategy that thrives on stability, or at least predictable instability. And right now, with Bitcoin and other major cryptos consolidating after their big drop, we are seeing these ranges form everywhere. So how do you do it? First, you need to identify the range. You look at the charts and draw two horizontal lines, one connecting the recent price peaks, resistance, and one connecting the recent price troughs, support. This creates your trading channel. The plan is simple. You place a buy order near the support line and a sell order near the resistance line. The beauty of this is that your risk is clearly defined. You place a stop loss order just below the support line, so if the price breaks down, your losses are limited. It's a disciplined, methodical approach that removes a lot of the emotion from trading. You're not trying to predict the next big thing, you're just playing the probabilities within a defined field. For the active trader, this is a fantastic way to generate consistent, albeit smaller, gains while the rest of the market is waiting for a trend to emerge. It's like being a landlord in a stable neighborhood. You're not going to get rich overnight, but you can collect a steady stream of rent. Now, if range trading is like being a landlord, our next set of strategies, yield farming and liquidity provision, is like being the bank. Instead of just trading your assets, you're putting them to work, lending them out to the decentralized finance or DeFi ecosystem and earning interest. It's one of the most powerful ways to generate passive income in crypto. And in a bear market, it can be a game changer. Instead of your portfolio just sitting there losing value with the market, it's actively generating a yield, offsetting some of the losses, and in some cases, even turning a profit. Let's start with liquidity provision. Imagine a small currency exchange booth in a foreign country. To swap currencies, the booth needs to have a supply of both. In DeFi, decentralized exchanges or DEXs work the same way. They need a pool of two different tokens, say ETH, and a stablecoin like USDC, so that users can swap between them. As a liquidity provider, you are the one who supplies those tokens to the pool. In return for providing this service, you get a share of the trading fees every time someone makes a swap. It's a beautiful system, and the returns can be very attractive. We're seeing annual percentage rates, or APRs, anywhere from 5% on stablecoin pairs to over 100% on more exotic volatile pairs. But, and this is a big but, there's a catch. It's a wonderfully nerdy term called impermanent loss. It's a bit complex, but the simple version is this. If the prices of the two tokens you provided diverge significantly, the value of your holdings in the pool can be less than if you had just held them in your wallet. It's the risk you take for the reward of those trading fees. It's not for the faint of heart, and it requires a good understanding of the risks involved. Then we have yield farming, which is a broader term that includes liquidity provision, but also encompasses other strategies like lending and staking. With lending, you deposit your crypto into a protocol like Aave or Compound, and other users can borrow it paying interest. You, as the lender, get a cut of that interest. It's generally less risky than liquidity provision because you're not exposed to impermanent loss. The returns are usually lower, but it's a more stable, set it and forget it approach. And then there's the new frontier of yield farming, liquid staking and delta-neutral strategies. With liquid staking, you can stake your ETH or SOL to help secure the network and earn rewards, but you get a liquid token in return that you can use in other DeFi protocols, essentially earning a yield on your yield. And with delta-neutral strategies, you're providing liquidity to protocols that use complex hedging techniques to earn a yield from market-neutral positions. These are advanced strategies, but they offer a glimpse into the future of finance, where your capital can be put to work in incredibly creative and efficient ways. The key takeaway here is that even when the market is down, there are still plenty of ways to make your crypto work for you. It's a paradigm shift from the traditional buy and hope strategy. In DeFi, you can buy and then you can build a business with what you bought. If yield farming sounds a bit too much like jumping into the deep end of the pool, don't worry. There's a much more straightforward and arguably safer way to earn a passive income on your crypto holdings: staking. If you believe in the long-term potential of a particular blockchain, like Ethereum, Solana, or Cardano, staking is like buying a government bond in that country. You are essentially locking up your tokens to help secure the network, and in return, the network pays you a dividend. It's a fundamental part of how proof-of-stake blockchains work, and it's a win-win situation. You help make the network more robust and decentralized, and you get rewarded for it. The beauty of staking is its simplicity. You don't need to worry about impermanent loss. You don't need to actively manage your position, and the returns are generally quite predictable. For major cryptocurrencies like Ethereum, you can expect an APR of around 3 to 5%. For others like Solana or Polkadot, it can be as high as 7 to 14%. Now, that might not sound as exciting as the triple-digit APRs you sometimes see in yield farming, but it's a much lower risk proposition. It's the slow and steady approach to wealth creation in the crypto world. It's perfect for the long-term investor, the hodler, who wants to do more with their assets than just let them sit in a wallet. And the best part is, you can do it directly from major exchanges like Coinbase or Kraken, or you can use decentralized platforms like Lido or Rocket Pool, which give you more control over your assets. Staking is a powerful reminder that you don't have to be a trader to be a successful crypto investor. You can be a participant, a supporter, a stakeholder in the future of the internet, and get paid for it. Now let's talk about a strategy that is so simple, so effective, and so criminally underrated that it's almost a crime not to use it. I'm talking about dollar cost averaging, or DCA. This isn't some complex trading maneuver that requires you to stare at charts all day. It's the opposite. It's the zen of investing. The principle is this: you invest a fixed amount of money into an asset at regular intervals, regardless of the price. It could be $100 into Bitcoin every Monday, $50 into Ethereum every payday, whatever works for you. The key is consistency. By doing this, you are averaging out your purchase price over time. When the price is low, your fixed investment buys you more crypto. When the price is high, it buys you less. It's a beautifully simple way to remove the two biggest enemies of the average investor: fear and greed. Think about it. The hardest part of investing is timing the market. Everyone wants to buy at the absolute bottom and sell at the absolute top, but the reality is almost no one ever does. DCA takes the guesswork out of the equation. You're not trying to be a hero, you're just systematically accumulating an asset you believe in over the long term. In a bear market, this strategy is particularly powerful. While everyone else is panicking and selling, you are calmly accumulating more and more of your chosen asset at a discount. It requires patience, it requires discipline, and it requires a long-term conviction in the future of crypto. But if you have those things, DCA is one of the most reliable ways to build wealth over time. It's the strategy that allows you to sleep at night, knowing that you are making a smart, disciplined investment regardless of the market's daily mood swings. It's the ultimate passive strategy. And in a market as volatile as crypto, it's your anchor in the storm. So we've covered a lot of ground, from the high-octane world of range trading to the slow and steady marathon of dollar cost averaging. But the big question is, which strategy is right for you? The answer depends entirely on your personality, your lifestyle, and your goals. Are you an active trader, someone who thrives on the thrill of the market and has the time to dedicate to it? Or are you a passive investor, someone who wants to build long-term wealth without being glued to the charts? Let's break it down. For the active trader, if you're in this camp, the bear market is your canvas. You're not just surviving, you're actively seeking opportunities to profit from the volatility. Your primary tool is range trading. You're identifying those support and resistance levels on the 1-hour and 4-hour charts, and you're trading the bounces. You're also looking at derivatives. The data from CoinGlass shows a balanced funding rate right now, meaning there isn't a strong bias in the perpetual futures market. This is an environment where a skilled trader can profit from both long and short positions. You might also be exploring concentrated liquidity provision on platforms like Uniswap v3. Instead of providing liquidity across the entire price range, you're concentrating your capital in a narrow band where you expect the most trading activity, amplifying your fee-earning potential. This requires active management, as you need to adjust your position if the price moves out of your range, but the rewards can be substantial. The life of an active trader in a bear market is one of vigilance, discipline, and a deep understanding of technical analysis. It's not easy, but for those who have the skill and the stomach for it, it can be incredibly rewarding. For the passive investor, if you're a passive investor, your mindset is completely different. You're not trying to time the market, you're trying to outlast it. Your number one strategy is dollar cost averaging. You're making your regular automated purchases of blue-chip cryptocurrencies like Bitcoin and Ethereum, and you're not worrying about the daily price fluctuations. You're also heavily involved in staking. You've locked up your ETH, your SOL, your ADA, and you're earning a steady, predictable yield. It's the ultimate set-it-and-forget-it strategy. You might also be dipping your toes into the safer end of the yield farming pool. You're providing liquidity to stablecoin pairs like USDC/DAI, earning a modest but reliable return without the risk of impermanent loss. The passive investor's game is one of patience and accumulation. You're not looking for a quick flip. You're building a foundation for the next bull run. You understand that the real wealth in crypto is built not in the euphoric highs, but in the quiet, disciplined accumulation during the lows. It's a less glamorous path, but it's a proven one. Now, we've talked a lot about opportunities and the intellectual thrill of finding an edge in this market, but it would be irresponsible and frankly a disservice to you if we didn't have a serious heart-to-heart conversation about risk. In the world of crypto, risk is not a four-letter word. It's a constant companion. And in a bear market, its shadow looms even larger. Ignoring it is like trying to swim in the ocean without acknowledging the existence of sharks. So let's put on our grown-up pants and take a sober look at what can and often does go wrong. The most obvious risk, of course, is market risk. This is the simple fact that the price of your assets can go down, and in crypto, it can go down a lot and it can go down fast. No matter how good your strategy is, you are still exposed to the overall sentiment of the market. A sudden regulatory crackdown, a major hack of an exchange, or a global macroeconomic shock can send prices tumbling, and your carefully constructed trading range or your high-yield farm can be washed away in the tide. This is why diversification, not just across different cryptocurrencies, but across different strategies, is so crucial. You don't want all your eggs in one basket, especially when that basket is being carried on a roller coaster. Next up is smart contract risk. This is the big, scary monster that lurks in the shadows of DeFi. Every yield farm, every liquidity pool, every staking protocol is built on smart contracts, which are just pieces of code. And code can have bugs, it can have vulnerabilities, and malicious actors are constantly searching for these vulnerabilities to exploit. We have seen countless examples of protocols being drained of millions of dollars due to a single flaw in their code. This is why it's so important to do your due diligence. Look for protocols that have been audited by reputable security firms. Look for projects that have been around for a while and have a proven track record. And even then, there is no such thing as a 100% guarantee. A good rule of thumb is to never invest more in a single DeFi protocol than you are willing to lose. It's a stark warning, but it's a necessary one. And let's not forget about impermanent loss, the silent killer of liquidity providers. We touched on this earlier, but it's worth repeating. When you provide liquidity to a pool and the prices of the two tokens diverge, you can end up with less value than if you had just held the tokens separately. The trading fees you earn are meant to compensate for this risk, but in a highly volatile market, the impermanent loss can often outweigh the fees, leaving you with a net loss. This is why providing liquidity to pairs of highly volatile, uncorrelated assets is so risky. It's a game of probabilities, and you need to understand the math before you play. Finally, there's regulatory risk. The crypto industry is still in a regulatory gray area in many parts of the world. Governments are still trying to figure out how to classify these assets, how to tax them, and how to regulate the platforms that offer them. A sudden, unfavorable ruling from a major government can have a chilling effect on the entire market. This is a risk that is largely out of our control, but it's one we need to be aware of. The best way to mitigate this is to stay informed, to understand the regulatory landscape in your jurisdiction, and to be prepared for the possibility of sudden changes. Risk management is not about eliminating risk. It's about understanding it, respecting it, and making intelligent decisions in the face of it. It's what separates the gamblers from the investors. We have journeyed through the icy landscape of the crypto bear market, and I hope you're feeling a little less like a lost explorer and a little more like a seasoned mountaineer. We've seen that this is not a time for hibernation, but a time for strategic action. It's a time to sharpen our tools, to refine our strategies, and to lay the groundwork for the next season of growth. We've explored the methodical, disciplined world of range trading, a strategy that allows active traders to carve out profits from the market's sideways dance. We've delved into the innovative and powerful realm of yield farming and liquidity provision, discovering how to put our assets to work and generate a passive income, even when prices are stagnant. We've appreciated the simple, elegant power of staking, a low-risk way to support our favorite projects and earn a steady reward. And we've embraced the Zen-like wisdom of dollar-cost averaging, a strategy that removes emotion from the equation and allows us to systematically accumulate wealth over the long term. We've also had a frank discussion about risk. We've stared into the abyss of market volatility, smart contract vulnerabilities, impermanent loss, and regulatory uncertainty. And we've come to understand that risk is not something to be feared, but something to be managed. It's through a deep understanding of these risks that we can make intelligent, informed decisions and protect ourselves from the catastrophic losses that can plague the unprepared. The key takeaway from today's episode is this: a bear market is not a crypto winter. It's a crypto university. It's a time to learn, to experiment, and to build a resilient, diversified portfolio that can withstand the storms and flourish in the sunshine. Whether you are an active trader or a passive investor, there is a path for you. The choice is yours. The opportunities are there for the taking, and the knowledge to seize them is right at your fingertips. Thank you for joining me on this journey today. I hope you found this episode to be not just educational, but empowering. If you did, please do me a favor and hit that like button. Subscribe to the channel and share this video with someone who needs to hear it. And as always, I want to hear from you. What strategies are you using in this bear market? What are your biggest concerns? What topics do you want me to cover in future episodes? Let me know in the comments below. This is a conversation, and your voice is a crucial part of it. Until next time, stay curious, stay disciplined, and remember, the best investment you can ever make is in your own education. This is Boni, signing off.